The Federal Reserve raised the Fed funds rate. So where do interest rates go from here? This is the weekly report on Major Money Matters. Welcome to Major Money Matters. My name is Major. I'm a mortgage broker powered by Edge Home Finance. And this is your first time here. You have stumbled across the weekly report where we give you information of what's happening in the economic world. And we also discuss whether it's affecting you as a buyer, as a seller, or if you're one of our realtor partners who gets this every single week. A lot of stuff to go through this week, a lot of market action. So let's get right to it. Okay. So let's start off with this article. And I want to start off with this article mainly because there's a lot of information being put out right now. Some of it is some little pieces of facts and people trying to connect the dots as best that they can. And some of these people are reporters or something to that effect, people who have deadlines and say, hey, I got to get something on paper to be able to release because I got a job to be a reporter. And sometimes they put things together that are not true, which involves you reading it and you constructing things and you're making decisions based on that may or may not be actually factual. So let's take a look at this article first from NPR. Okay. And first of all, I got nothing against Becky Sullivan, whoever you are. God love you. I hope you're doing well. But there are some things in here that are kind of misleading. So she starts her article off with asking the title of the article, who are the winners and losers of the Fed hiking interest rates? I will tell you the answer to that question, to the Fed hiking interest rates, is people who are actively people who are actively looking for houses right now. Okay, that is the answer to that question. And I will lay that out and demonstrate that to you as we go through this. She posted in here, losers, people who are trying to buy a home right now. So we already had a disagreement, Becky. We're already at a disagreement here and we're not even really into your article yet. By the way, I'll post a full article in the comments here. So she writes, the Fed's interest rate isn't directly tied to mortgage rates. Very true. But mortgage lenders move their rates up and down based on what they expect the Fed to do. Sort of, kind of. With inflation so bad right now, mortgage rates have been rising all spring. Today, the average interest rate is well above 6%, according to Mortgage News Daily. Now, when she says that, that's not entirely true. That's an average of all interest rates across the nation. So, for example, I have people who are in jumbo VA rates at 4.4, 4.5. But I have people who are in conventional loans with little money down, maybe a little bit worse credit score, that are in the sixes. So she's talking about an average interest rate across all spectrums, people paying points. By the way, this is also included primary properties, investment properties where interest rates are higher. She's also likely including non-qualified mortgages in that also, and adjustable rate mortgages. So you don't say, hey, I'm buying a house, my interest rate is going to be 6%. If you're in a VA loan, probably not. All right, earlier this year, the 30-year fix was around 3.25. Okay, so let's talk about this and break this out. I've made some notations on the chart for this week because I want you to follow along on what exactly happened, because anybody who believes that the Federal Reserve raised Fed's funds rate by 0.75, so therefore your interest rate is going to be 0.75 higher, is totally emphatically wrong. I have realtors that believe this. I talked to other mortgage professionals that believe that's not the way the market works. So let's talk about what happened. Now, this week, the CPI, the Consumer Price Index, the CPI numbers for May were released. Now, this data lags behind about a month. So the numbers were released for May on this past week. Go back and watch the weekly report from last week. I go through it. I don't have time to get into it right now. But the market when those numbers showed that inflation was higher, the bond market reacted by investors charging a higher rate on bonds because they need more on their returns to pay for to cover the inflation because they are investors. So they want higher returns on their investment in order for basically in order for them to buy goods and services, to do other investment stuff like that. So they're charging a higher rate, which means you get charged a higher rate on your long-term security, which is a mortgage. Okay. Friday, bad day for the bond market. Monday, catastrophic day for the bond market. It was absolutely terrible. I think we went up like 120 something basis points. If you're correlating that, that means mortgage interest rates went up about, depending on the bank, from 0.25 to 0.5 in one day. That was bad. Tuesday, another bad day. And then Wednesday comes. And the Fed says, hey, we're going to hike the Fed funds rate by 0.75 in order to curb inflation. I will tell you that going back to the last 2 years, the Fed did not see this coming in. They did not do enough to curb inflation. Therefore, they're now playing catch up. So I believe they're going to play catch up to an extent where they're going to hike us basically into a recession. All right. So when they raised the Fed funds rate, and I notated here on how mortgage-backed security, and I should have put up, I'm not going to get into it right now, but the 10-year Treasury, I should have explained that chart too, but let's focus on this one for right now. Because they hiked the Fed funds rate and investors believe they were doing something about inflation, then they basically stopped the bleeding. So they stopped the bleeding, and if you were buying a house right now, the interest rate that you would expect to pay for a mortgage would have continued to be higher if the Fed didn't do something. But because investors believe that they're doing something about inflation, that stopped the bleeding and stopped the interest rates, or they stopped the bond market from going higher. That gives us, better pricing on mortgages, which I've told you before. When the Fed hikes interest rates, or hikes the Fed funds rate, as I should say, it actually tends to help mortgage rates. Go back to my video where I talk about the real reason interest rates are rising. All right. So we talk about inflation and the effects there. So next thing I want to talk about is, where do we go from here? Okay. Really, really quickly. The things that I'm looking at to see whether interest rates continue to go up or whether we get some reprieve. Okay. And people who say, yeah, by the end of the year, interest rates going to be at 8%. Sure. I guess that could happen, but you really don't know unless you're being like kind of retroactively looking back where you were, or just like people say, hey, I'm buying a home at the peak of the market. You don't know what the peak of the market is probably until 6 months to a year later. So, you can't know until you look back retroactively. So the things that I'm watching, number one, international inflation. So we get our U.S. inflation numbers, and I'm going to talk about that at the end of this video. We get our U.S. inflation numbers, but the international inflation numbers. Inflation is an international issue right now. So you see other banks that are increasing their federal funds rate, or whatever they call it in their government. You see the Swiss raise their rate by 0.5%. So why is this important? Because the Swiss is normally very conservative. They're like, let the markets do what the markets are going to do. We're not going to get involved. They're normally very conservative, and they raise their federal funds rate by 50 basis points. The Bank of England raised their federal funds rate to try to curb inflation. So you see all of these federal entities from different nations raising their federal funds rate in order to stop inflation or curb inflation. So that's number one thing. And the effect of the international world, or the international inflation numbers, could have an impact on our U.S. economy and push our interest rates higher, the required price on bonds to be higher, which would increase our interest rates. So the other thing I'm looking at, China's strict zero COVID policy. China has a very, very strict policy about COVID, and they are willing to shut down certain clusters of people in certain communities, in certain neighborhoods, if they see a COVID outbreak. Now, this causes China to be in a situation where investors are very apprehensive to invest in China. So you're seeing a humongous impact on that, and I'm looking at whether that impacts our world economy, whether that shuts down. I mean, China's the second largest economy right now. So if that happens to have an impact on our world economy because they're so interconnected, we could end up with higher interest rates. The war in Ukraine, I think we're at like day 114 of the war in Ukraine. And, you know, Americans are really interesting in this way. The farther away something is from us, the more we forget about it. So Ukraine was big news before. There's still a war going on. There's still people being killed and stuff like that. But people have just stopped talking about it. It's interesting. We're at day 14, day 114 or day 115 of that. But that's having a impact on supply chain and getting products and services or getting products to the U.S. because Ukraine produces some items. Ukraine is very rich in resources, which is why Russia is invading them. But you know how that impacts our supply chain and stuff like that. So the other thing is our U.S. CPI numbers. And I want to end with this because, you know, these numbers come out on a monthly basis. And I'm putting this chart up right now because if you're happen to be one of these people that say, hey, I'm going to float my rate or something like that and try to get a better rate. If you're near the middle of the month where the CPI numbers are coming out, you are essentially a gambler. Because there's so much volatility around these CPI numbers. There is no way that I would be floating a rate around the middle of the month. I'm going to lock it in and just move on. Chances are you're going to be in a recession in the next 6 to 8 to 9 months. Anyway, you're probably going to be refinancing that mortgage. Anyway, sometime in 2023, you just take I would be taking what I have and move on. But if you're one of these people who want to float and you want to take chances, there's no way I'm floating around the middle of the month. But so where do we see rates going? If we have these external factors that affect our U.S. market, and we have situations where inflation continues to be an issue, which I do believe this is going to happen over the next 2 to 3 months because the CPI numbers are replacing much lower CPI numbers from last year. So you're going to see year over year inflation be higher. I believe you're going to continue to see this through the summer months, hopefully tapering off in the fall. So if I believe that the bleeding has temporarily stopped, but I also think when the new CPI numbers start coming out, you're going to see these interest rates continue to go higher. So my advice, if you get under contract, if you like it, lock it. If you like it, lock it. If you like it, lock it. If you like the rate that you are being presented, lock it in. All right. Now, there are some opportunities. I've talked about this before where you can lock at one investor if you have a longer escrow or something like that. I'm a broker. I have access to 46 different lenders. If I lock you at one investor, then I do have the option to shift you to another investor if that escrow is at 60 days or 90-day escrow or something like that. But you have to lock what you have because you never know what this market's going to deal us. We are simply in a very, very, very volatile situation. You see the width of those lines, of the movement in the market. That means that, if you're comfortable, let's say you have a 5% rate. That means that 5% rate, because of the amount of volatility in that day, you can go from getting 5% with no credits to 5% with $2,000 of credit, or from 5% to 4.9 or 4.8. So, there's a lot of volatility. If you have a friend who's looking for a mortgage, tell them to call us, because I have seen retail banks who are pricing mortgages much higher than brokers are. So I would tell them to give us a call. Make sure you're getting the right, a good interest rate. Make sure you're doing that, because there's a lot of volatility in the market. There's usually a lot more variance or flexibility on the broker side to make sure they're getting a fantastic deal, although those rates are a little bit higher. So talk to you guys soon. That's it for this week. It's a volatile situation. We got to make the best of it and keep moving forward. We'll see you next time on Major Money Matters.